What's good, family? Welcome back to Rich Cousin, the channel where we talk about how to earn more, save better, and invest wiser so you can really level up financially. If that's the kind of content you're on, go ahead and subscribe right now. Because on this channel, we're not just talking about money to sound smart, we're talking about money so you can actually change your life.
Facts. And that's exactly why most people never start. They hear words like index fund, portfolio, limit order, dividends, and they're already mentally checked out. Okay, let's start from the top. Why should somebody even invest? Like, why not just save money in the bank and call it a day?
Great question. There are two major reasons. First, inflation. Second, compound growth. Let's tackle inflation first. A lot of people think that if their money is sitting safely in a regular bank account, they're doing the responsible thing. And yes, saving money is important, but if your cash is just sitting there long term doing nothing, it's quietly losing value.
So, in other words, not investing has a cost too.
That's what people miss. They think doing nothing is safe, but doing nothing also has consequences. Now, the second reason to invest is where things get exciting: compound growth. If the only way you make money is by working harder, then there's always going to be a ceiling. But when you invest, now your money becomes an employee too. And this is where that phrase comes from. It takes money to make money. If you've got $1,000 invested, the growth will be modest. If you've got $100,000 invested, the growth feels different. If you've got $1 million invested, the game changes completely. That's why investing matters. It helps you build leverage. Because for most beginners, stocks are one of the easiest, most accessible, and most practical ways to start. Let me break it down. First, stocks are easy to access. You don't need $50,000 for a down payment. You don't need tenants. You don't need to know how to renovate a basement or flip a property. You can literally open an account from your phone and start. Third, over long periods of time, the stock market has historically gone up. Not every day, not every month, not every year. But over long stretches, the trend has been upward. That's why long-term investors win. Now, does that mean stocks never drop? Of course not. There will be crashes, corrections, scary headlines, and days where people act like the world is ending. But if you zoom out, the bigger picture has historically rewarded patience. Bingo. People want day one results from a long-term wealth strategy. Investing is not supposed to feel like gambling. It's supposed to feel boring, steady, and effective. That's how wealth is built.
All right, so let's say somebody's sold. They're like, cool, I'm in. What's the first actual move?
You need an investment account. Think of it like opening a bank account, except this one is specifically for buying investments. Now, there are generally two broad buckets. One, retirement-style accounts. Two, regular brokerage accounts. Retirement accounts usually come with tax advantages, but there are rules around when and how you access the money. Regular brokerage accounts are more flexible, but you may owe taxes when you sell investments for gain.
This is where people get stuck the most because once they open the app, it's like, now what? Apple, Tesla, Nvidia, random ot stock on social media?
And that's exactly how beginners get cooked. Look, can you invest in individual companies? Yes. But should that be your main beginner strategy? Usually no, because buying one stock means you're betting heavily on one company, and even great companies can underperform for years. That's why for most beginners, index funds and ETFs make way more sense. Say you don't want to bet your whole future on one basketball player, you'd rather own the whole team, better yet, the whole league. That's what an ETF or index fund helps you do. Instead of putting all your money into one company, you buy one investment that gives you exposure to many companies at once. So if you buy an S&P 500 index fund, for example, you're basically buying a slice of hundreds of major companies all in one move. That means instant diversification. The internet loves making simple things sound complicated. But the truth is, a lot of wealthy people built serious portfolios doing very basic things consistently for a long time. Not flashy, just disciplined. And that mindset keeps people stuck for years. For most people, the best answer is start as soon as you reasonably can, because time in the market usually matters more than trying to perfectly time the market. Let me say that again. Time in the market beats timing the market for most beginners. That's the trap. Could the market drop after you invest? Sure. Will that feel annoying? Absolutely. But if your plan is long term, those short term moves matter less. That's why a lot of people use dollar cost averaging.
So it's less about being perfect, more about building the habit.
Exactly, because wealth usually isn't built through one genius move, it's built through repeated good decisions. That's real. And here's what I'd say: you do not need a ton of money to begin learning how to invest, but you do need realism. If you're barely surviving, drowning in bills, and have no emergency cushion, then yes, it may make more sense to stabilize first, because investing should come from strength, not desperation. But once you do have stable income, then yes, start investing what you can. It doesn't have to be huge. Even $50 or $100 a month matters because it builds the habit and gets you in the game. And as your income grows, you raise the amount.
Consistency beats intensity. A person investing
Modest amounts for years often beats the person who waits around trying to start big someday.
Before we wrap, can we hit some beginner mistakes real quick? Because I know people listening are probably ready to mess this up somehow.
Absolutely. Let's save them some pain. Mistake number one: waiting forever. Too many people stay in research mode for years. At some point, you have to start. Mistake number two: trying to get rich quick. Investing is not meant to replace patience with hype. Mistake number three: buying things you don't understand. If you can't explain what you own in simple words, slow down. Simple. First, I'd get clear on my budget and make sure I'm not investing money I might need next week. Second, I'd build at least a small emergency cushion if I don't already have one. Third, I'd open an investment account. Fourth, I'd choose a simple, broad market ETF or index fund strategy instead of trying to play stock picker. Fifth, I'd automate contributions, even if it's small. And sixth, I'd keep learning without overcomplicating it. That's it. So, to wrap this up, if you've been scared to start investing, let this be your sign to stop overthinking and start learning the game properly. You invest because inflation is already working against you. You invest because compound growth can change your future. You start simple because simple works. You focus on consistency because consistency builds wealth, and you stay patient because this is a long-term play.
So if this episode helped you, make sure you subscribe to Rich Cousin for more content on how to make more money, save smarter, and invest
Better. Drop a comment below and tell us where you are in your journey. Are you just getting started? Have you already invested your first money? Or are you still trying to understand all this without getting overwhelmed? We're building for real over here. And send this video to a friend who keeps saying, I want to start investing. I just don't know how. This might be the episode that finally gets them moving. I'm Rich Cousin,
And I'm John.
and we'll catch you in the next one. Peace.